Good afternoon, and thank you so much for joining us. My name is Andrea Krupp, and I'm the Director of Planned and Estate Giving here at Providence College. I want to thank you for joining this latest Money Matters webinar. Today, we're going to talk about the One Big Beautiful Bill Act, which was passed on July 4th, 2025, and how it might impact you and your philanthropic decisions this year and next year. While our guest and I are both attorneys, this presentation is informational only, not intended to be legal advice. But we hope that if you hear something that resonates with you, you will go back and speak with your own personal advisors to learn more. We'll leave time during the presentation and at the end to address as many questions as we can. Please use the question and answer feature, which you'll see on the bottom of your screen, and that's where you can type in any questions. This webinar is being recorded, and the link will be sent out after this session so that you can rewatch it or forward it to friends. And we'll also have the link in our planned giving website. It's my pleasure now to introduce our speaker today, Attorney Elizabeth Manchester. Liz is a proud alumna of Providence College, class of 2002, and later getting her MBA here in 2016. Liz is a partner at Partridge, Snow and Hahn, where she focuses her practice on estate planning and charitable giving. She's especially skilled at helping individuals and businesses align their philanthropic goals with their personal and professional objectives. Her expertise and her leadership make her uniquely qualified to guide us through today's important discussion. Liz, thank you so much for joining us.
Thanks for having me. Providence College certainly is a big part of my life, so it's really wonderful to be able to give back like this. And it's been fun for me recently. I've actually been teaching a class at PC to all the business majors. So that's been great for me to reconnect with students and keep me sharp. You know, they always keep me on my toes. So
they do that.
But not teaching a class here tonight in the typical fashion, but we're talking about the One Big Beautiful Bill Act, which has never been able to quite roll off my tongue, so I call it OBA. And as you said, it was passed on July 4th, signed into law this year by President Trump. This bill is a whopper. It addresses many different topics, and we are only skimming the surface here today as we're talking primarily about income tax planning and philanthropy, certainly in charitable giving. Some of the other things you may have heard about pertaining to the act, and I just want to give you an overview in case you're like, I thought I heard about this. And certainly we won't be able to talk about everything here today, but the act addresses things like qualified small business stock benefits, provisions regarding tips and overtime, a lot of provisions related to stimulus around research and development and business investment, provisions around opportunity zones, if you're familiar with that, international tax issues. So this bill addressed, it took some time to pass, of course. Its provisions are vast, but we're going to dive in today, since we're here for Providence College, to talk about your end of year planning and planning for next year and during the term of the act as it moves forward. So we have Allie flipping the slides here for me today. And so thanks, Allie. And we're going to start off with talking about everyone's favorite topic as we think about income tax planning, but standard deductions. So just to, again, give you the 10,000-foot view, right? As you're preparing to file your income tax returns every year on or around April 15th, everyone's favorite time of year, we're calculating and we're looking at and thinking about your deductions available from the prior year. And generally under the law, you have the ability to take a standard deduction or itemize your income tax deductions. In the prior iteration of the Tax Act, the Tax Cuts and Jobs Act, the TCJA, that was passed in 2017, originally by President Trump, made a significant change to the standard deduction. It doubled the standard deduction in 2017. And so with that, as taxpayers were looking at and calculating their income tax deductibility in any given year, most Americans are taking the standard deduction. The IRS compiles data on an arrears basis. The most recent data, I think, is available from 2022. But what it's showing is that really 9 out of 10 Americans are taking the standard deduction. other calculations from the Tax Policy Institute to other foundations that collect this data, 85% or so to 95% of Americans in most years will be taking the standard deduction. And that's because it's quite high. And so you see a continuation of that with the One Big Beautiful Bill Act, preserving that larger standard deduction and increasing it slightly. Here we're saying to $15,750 for a single taxpayer and $31,500 for married filing jointly. And that will have an increase for an inflation every year during the term of the act. And I point this out to say in a few slides, we'll talk about ways that the act actually allows you to take the ability for a charitable deduction, even if you are taking the standard deduction. But it's also just setting the stage, you know, with America and how we're thinking about our charitable giving. This standard deduction really changed the way a lot of people were accounting for their income taxes. As I said, most people are taking the standard deduction. What we do know, right, from a lot of statistical data is not everyone, and actually most say they are not primarily motivated by taxation when thinking about their philanthropy, right? I'm sure everyone here on the call loves Providence College, and that probably is your primary motivation for making your gift. But obviously taxation and benefits from taxation do play an important role. So we wanted to certainly make everyone aware of that this concept of a larger standard deduction is preserved under the One Big Beautiful Bill Act.
And Liz, is that increase, does that apply for the 2025 tax year, or does that start next year?
Yeah, so that will start, you know, most provisions of the act go into effect January 1, 2026. So this will really apply for you to think about this increased deduction, right? For tax year starting January 1, 2026. You know, there's still a large standard deduction in this tax year. Off the top of my head, I can't recall what it was. I think 15,000. But it's increased slightly starting January 1, 2026. Okay, so moving on, and I think Andrea said this, but if you have questions, pop them into the Q&A. We'll address them as best we can as we go along or at the end if we have time. Okay, so modifications and enhancements, again, we're still just painting the landscape for you here as you think about your income tax planning as it relates to your philanthropic planning. One of the changes with the OBA is it increased the SALT cap. Now, what is the SALT cap for those of you who may not be familiar? This is a way for you to get, if you're not taking the standard deduction, as we discussed on the prior slide, and you're looking to okay, I'm going to think about what are my itemized income tax deductions? If I'm not going to take the standard, how can I get over that hump of the $15,750 starting in 2026? There's certain ways you can take itemized income tax deductions. For those of you who are interested, that would be your Schedule A on your income tax return. And so this SALT cap, which is a type of itemized income tax deduction for state and local taxes. Okay, for state and local taxes, that's what SALT stands for, is up to now $40,000. Prior to this act, it was set at $10,000 for years 2025 to 2029 for those with less than, again, what you'll see in a lot of these provisions related to the act is there are thresholds related to your adjusted gross income. So if you have less than $500,000 for adjusted gross income for a single person or married adjusted gross income, it's going back to $10,000. So what you have to realize for all of these benefits for these provisions in the act, and we'll be mentioning these as we go along, there are thresholds set for your income for you to enjoy some of these benefits. For a lot of people, especially those in high property tax areas, this increase in the SALT cap will be particularly compelling because that's how most people are getting up to this $40,000 limit. The Tax Policy Center, for example, estimates that with this increase in the SALT cap, there may be up to 5 million more itemizers in the United States, not taking the standard deduction, but looking to perhaps itemize their deductions. And just to keep that in mind, right, there's 342 million people in the United States. But 5 million more, that can move the needle a little bit. While we're on this slide and talking about itemized income tax deductions, other itemized income tax deductions you might be thinking about and seeing are those related to mortgage interest, which is still set at loans generally at $750,000 capped. You might have dental or medical expenses, which have certain caps as well. And what I want to reiterate here is with all of these available itemized income tax deductions for your Schedule A, still the most compelling is the charitable income tax deduction, right? We'll talk about in any given year, there are some ceilings depending on the type of your gift that you can take on a carry forward basis, but there really are not thresholds and caps to your charitable income tax deduction in the same way there are for these SALT caps or your mortgage interest cap. So the charitable income tax deduction, if you are looking to itemize and get over that certainly standard deduction amount, still the most powerful under the tax code in terms of the type of benefit that it can mean to you. And I pulled some data just to look at who, in the United States currently, how many people are demonstrating that they're taking a charitable income tax deduction. And it's actually, I thought, pretty high. 38% of tax returns show that they're making some kind of charitable contribution. We would love, of course, for that to be higher. But particularly those that are high income earners, meaning they have an income over $1 million, account for about 88% of that statistic. So for those who are in that threshold of making $1 million or more, typically and statistically, they are really looking hard at the charitable income tax deduction and how it can benefit them. Okay. So that's a summary and a highlight of some of the available changes to various itemized income tax deductions on this slide. And with that, we can move on to the next slide, which is an enhancement, especially for seniors 65 and older. This is a new senior deduction under the One Big Beautiful Bill Act. And we thought it was just, we thought we would point it out here today because it is certainly relevant to anyone on the call who is 65 and older or approaching 65 and older. It's a new deduction, $6,000 for a single filer, $12,000 for joint filers. Again, this does phase out at certain income thresholds, being $75,000 for a single filer and $150,000 for joint. And the interesting thing about this, it is available whether or not you are itemizing your income tax deductions. So this is a new enhancement, certainly, for seniors under the One Big Beautiful Bill Act. And if you are falling into this category, you should certainly talk to your CPA, whoever's helping you file your income tax returns, about ways you can really maximize this, maybe with looking at how, if you're thinking about charitable giving in a certain year or something like that, how it can maximize if you're having an income tax event or a deferred income event, what makes the most sense. But certainly a real enhancement under the One Big Beautiful Bill Act for seniors 65 and older.
And Liz, one thing, for seniors who are 65 and older and married, do they both need to be 65 to take this? So if one is 64 and one is 65, how does that work?
Yeah, that's a good question. I believe they do have to both be 65, but we can check on that and get back to you.
That was my understanding too, but I wanted to
believe
check
that's
with you.
the case. Yes.
Okay.
Okay, so now we've sort of set the tone with some of these new existing enhanced itemized income tax deductions. Let's go on with the next slide here, if we can flip, with some real pertinent changes to charitable deductions. As I said, I do believe the charitable itemized income tax deduction remains to be the most flexible and powerful in some ways, in terms of not having, in some sense, a real strict ceiling for you. But there are some important changes under the Act for you to be aware of, certainly as you plan your year-end 2025 giving and looking to the next 4 or 5 years. So let's talk about some of them. One is this introduction of a floor of 0.5% on your itemized charitable deductions. What does that mean? So, for example, if you have AGI in 2026 that is $500,000. The 0.5% is of the contribution base. So that's what we're looking at. Your adjusted gross income is. A donor contributes $20,000 to Providence College. The first 0.5% of that contribution base, which would be $2,500, would not be includable in your itemized income tax deduction. So in other words, the first 0.5% of that gift is excluded in terms of how much you can itemize. The policy thought behind this, I believe, on some level, may have been to encourage larger gifts to get over that 0.5% floor. But certainly, I think you will see some impact to people's planning with the introduction of the floor, again, which will start in 2026. And I'll give some more examples in a minute of that and strategies for your 2025 planning. With the floor, we're also seeing caps on itemized deductions for those in the highest income tax bracket of 37%, which will effectively truncate your deduction amount to 35% in any given year. So in other words, you only get 35 cents on a dollar for your charitable itemized income tax deduction if you are in that highest tax bracket of the 37%. You'll see some truncation of the ability for you to take that high 37%, 37 cents on the dollar amount. So let me give you an example of this. If your adjusted gross income is $1 million, you're in that high income tax bracket, you make a gift of $100,000, you'll have that floor concept, right, of the 0.5% that I mentioned on the first $5,000, and you would have some limit compression at the top of your gift and the amount of about $5,400, which is this, you get into this crazy calculation under the tax code of 237. So I won't, bore you with that. But effectively, what that's happening is for someone who's in that $1 million tax bracket, making that $100,000 gift, your itemized charitable income tax deduction will be effectively $89,600. And that's the impact of the floor and the ceiling. What does this mean to you? What a lot of people are contemplating in 2025 to avoid perhaps this concept of the floor and or the ceiling for your end of year giving is you may want to think about now, right? If you were thinking about making a more substantial gift or any gift, dollar for dollar, you might have a better impact, obviously, with the avoidance of the floor and perhaps the compression in the top of the tax bracket by making that gift in 2025, because you're going to get, a regular income tax deduction as you would have in prior years. You won't have the exclusion of the floor amount. So some people are seriously thinking if they were going to make a more substantial gift, or just as they think about their next 5 years of giving, we'll give some other strategies for this in subsequent slides. But I just wanted to highlight this here, that this is motivating some persons to seriously think of, with their end of year giving in 2025, making a more substantial or a gift, or if you were thinking of putting it off to next year, a gift this year to avoid the floor. So,
and Liz, just to clarify, the cap is for the folks in the 37% tax bracket, but the floor is for everybody.
That's right. The floor applies to everyone. That compression to basically effectively putting someone in the 37% tax bracket into a 35% tax bracket, still a high tax bracket, only exists for those in that high 37% tax bracket. So that is true. The floor applies to everyone, so that much will be much more, for most people, a motivating factor to perhaps think about giving in this year to avoid the floor. Yes. Okay, so that's an important change under the Act, one you should certainly be aware of and that we wanted to highlight for purposes of this seminar. The other important change is a concept of a universal charitable deduction, which does make available and permanent for, I say permanent and I laugh, it's just until the next act is passed, but at least for the foreseeable future, permanent, a universal charitable deduction available to all taxpayers. So even if you are taking that standard deduction that we mentioned in the first slide, and you make a charitable gift, this charitable deduction will be available to you in addition to the standard deduction, right? So with caps, of course, $1,000 for individuals and $2,000 for joint filers, but typically you might not have seen some tax benefit to that. So this is an enhancement in terms of charitable giving. This is going to allow that large subset of the population who would have just taken the standard deduction to take the standard deduction plus get a universal charitable deduction if, of course, they do in fact make a charitable gift up to 100, again, this $1,000 and $2,000 cap amount. This is not available. Providence College is known as a public charity under the tax code. This universal charitable deduction is not available for gifts to donor advised funds, which is a very popular method for charitable giving, which I'm sure many of you may be familiar with. The most popular ones are Fidelity, Schwab. They have large donor advised funds, which are charitable entities. They're treated differently under the tax code. Also, many community foundations, for example, community organizations, and in some cases, some higher ed institutions, some privately held, privately operated type of charities that are public charities might start their own donor advised fund. Again, I'm telling you what this is. I'm sure many of you are familiar with them, but they have specific tax rules and regulations that have been pending for the past many years and have not been passed, but that are pertinent to donor advised funds. And they are treated differently under the tax code with regard to charitable giving in many different contexts. And this is one. They're a very popular method for charitable giving. They're the high DAFs, donor advised funds, are highly growing every year. It's the most popular type of charitable giving vehicle that's growing quite quickly. And what's the benefit to them? Donor advised funds allow for you to make a charitable gift in a certain year and defer the distribution from that fund. Again, according to whoever the administrator is, Fidelity or your community foundation, they might have different policies that govern the administration. But generally, under the tax code, you don't have to distribute a certain amount in any given year. You can make a large and substantial charitable gift in 1 year and then wait to decide how it will be distributed. We'll talk about DAFs, I think, in the subsequent slide as well. But I'm highlighting all of this for you to know, if you do have a DAF that you use a lot, or you're thinking about starting a DAF, this universal charitable deduction will not be available for a gift currently under the donor advised fund. And I should say, for all of these points that I'm making pertinent to the act, there will be subsequent regulations issued which have not come out yet and could change some of this. But again, universal charitable deduction, a benefit and enhancement that I think will benefit public charities like Providence College with the passage of the act. Another point I just wanted to highlight as well, we saw the permanency of the ability to deduct 60%, up to 60% of adjusted gross income for cash gifts to public charities like Providence College. So this provision of an enhanced AGI deduction was introduced during COVID, I think. COVID times, we always talk about it during COVID, the period we'd all like to forget, I'm sure. But one of the good things was that you could get this enhanced 60% AGI deduction for cash gifts to public charities. And then it was sort of on a de facto every year annual basis played around with. It used to be 50%. And just to remind everyone and to go over the fact that when you make cash gifts or gifts of appreciated securities, short-term, long-term, under the tax code, they all have different ceilings and thresholds for how much you can deduct in any given year, but you can carry forward that amount for up to 5 years. So cash gifts, allowing for the most deductibility under the tax code, again, up to 60% of your adjusted gross income, you can take as a deduction in any given year. If you're hitting that threshold, you can carry it forward for up to 5 years. It used to generally be 50%, but under the One Big Beautiful Bill Act, they made this 60% deductibility ceiling permanent, again, quote unquote, permanent for the lifetime of the act, to encourage cash gifts to charities, I think. And as it is the most flexible for most organizations, just in terms of how to accept them. So that was another beneficial provision, I believe, that we saw in the One Big Beautiful Bill Act related to charitable giving. We can go on to the next slide. I just wanted to highlight this for anyone who on the call who is a small business owner. We see this concept of a floor also relevant and introduced with this act in terms of the deductibility for charitable contributions made by corporations. And when I'm talking about corporations on this slide, we're pretty much referring to what's known as C corporations under the tax code, and I could bore you for an hour about what that means. But if you're a
No,
business
thank you.
on the call, you know who you are. So what I just wanted to highlight here is, obviously, corporate philanthropy, corporate giving, it's very important for small business owners and for other types of entities. I'm sure many in the community are always thinking about it. So here, similar to the 0.5% for individual contributors, here for corporate giving limits, there's this introduction of a 1% floor in terms of when you can actually take the benefit. You have to exceed the 1% of the taxable income for the corporation, which generally the maximum deductibility for corporations is 10% of taxable income for under the C Corp concept. So again, this will be really very relevant in upcoming years and next year as corporate giving, corporate philanthropy is contemplated for any business owners on the call. So now we're going into the next slide on some of these other alternative type charitable vehicles. And I think they've always been beneficial and flexible in many ways. And I know Providence College is benefiting in many ways from a lot of these different entities and vehicles. But I think with some of these changes under the tax law, we'll see an even more keen interest in how these might work for you as a donor and impact your overall charitable planning, estate planning, whatever the case may be. So I wanted to highlight what's known as qualified charitable distributions, QCDs, as they're abbreviated sometimes. And these are, we call them rollovers, charitable rollovers sometimes, which I think can be a little confusing in terms of the name. But it is available to anyone who's over the age of 70 and a half. If you have an IRA in any given year, you can roll over directly to a public charity up to, I think it's 108,000 in the current year. It's usually graduated for inflation. Every year, you might get a little bit more availability to do this. You have to contact your plan administrator. The rollover or the check will be, wired or distributed directly then to Providence College. Why would you think about doing this? Well, a few different reasons. IRAs, retirement planning vehicles are one of your most heavily taxed assets, right? In terms of you're paying income tax. Once you reach age 73 now under the tax law, you're taking your required minimum distributions. You have to start taking your distribution from your IRA, and that's taxable income to you. And there's limited planning options in terms of your long-term planning with these IRA assets. So the QCD has always been very tax effective. And here you also have the ability, as I said, you don't have to take that required minimum distribution until age 73, but you can actually take advantage of these QCD rollovers at 70 and a half, which is great. The other good thing about the QCD is it doesn't increase your adjusted gross income, right? So you don't have more taxable income if you're using the QCD, and also then doesn't increase your Medicare amounts. It doesn't increase your Social Security tax obligations or your effective rate. So you don't get the charitable income tax deduction when you utilize a QCD in your planning. But it does have these other enhanced benefits, and it is obviously accomplishing your charitable giving, which is very important. It's lessening the value of a highly taxed and always highly growing asset, and it's super easy to accomplish. It's a great option to utilize in conjunction, perhaps with your payable on death provisions, if you're looking to make a long-term deferred gift to Providence College. But the QCD with some of these concepts of the floor and the ceiling, especially for some donors, and for all donors, as we mentioned, the floor will be relevant. Great way for you to consider, because it's outside the auspices, obviously, of the traditional charitable income tax deduction calculation. You don't get the deduction, but it's a way for you to make a charitable gift. It's easy for you to accomplish. It's giving you these other benefits of not increasing your adjusted gross income, not impacting some of your Medicare, your Social Security issues, and easy to accomplish. So I really encourage you all, if there's anyone in that age group on this call, the 70 and a half and older age group, to really think about using your IRAs for this type of gift.
Liz, let me jump in here quickly because this is something that we see, especially toward the end of the year. Lots of gifts coming in this way, and we love them. They are very easy to do, but I'm going to reiterate a couple things you said. The important thing is that that money never sees your hands. It never goes into your bank account. It comes directly from the broker to Providence College or whatever charity you're giving to. Otherwise, it is counted as income. So that's really important. Don't try to do this on your own without talking to a broker or call the charity, hopefully Providence. But the other thing is, if you're thinking about giving a gift of cash in the same year that you have an IRA distribution available, this is a way to not, and if you are 73 and are required to take your distribution from your IRA, by using that IRA distribution, you are not paying income tax on that gift that you would be making anyway. So it is a really nice vehicle that Liz just highlighted. If you are thinking about doing that this year, please talk to your broker quickly, because there is some kind, sometimes a little turnaround, and you want to make sure that it gets given before December 31st.
Great. Very good point. It does take some time, as you said.
Yep.
Okay. And so moving on to donor advised fund, I mentioned and gave an overview about what a donor advised fund is if you're not familiar with these concepts of the floor for both corporate distributions and individual distributions. With the new act, we'll probably see an increase in this concept of bunching for people who do have donor advised funds set up, or perhaps might even think of setting one up in light of some of these benefits. So the concept of bunching would be, for example, if you had an idea in your mind, or maybe typically you give $20,000 per year to Providence College. That's what you've been doing, or you were thinking in the next 5 years, this is what I'm thinking of doing. I'm going to give $20,000 per year to PC. Now with this concept of the floor, right, you're going to, that 0.5% will be excluded if you really wanted that full throttle of the charitable income tax deduction, right? Which is obviously just one component of your planning. But that might maybe tip you to think, okay, I was going to give $20,000 per year. Next 5 years, I have that $100,000 available now, which is not true for everyone, right? Many people maybe need to actually parse it out over the 5-year period. But if that were the case, that you had the $100,000 in cash, securities, whatever the case may be now, to put into a donor advised fund, we think this might motivate people to make that larger gift in this year, or really in any given year, but certainly in this year, to a donor advised fund, the full $100,000. And then, of course, as I mentioned, you have the flexibility with donor advised funds to say, hey, donor advised fund administrator, I'm going to request, right, because it's technically the donor advised fund administrator's asset, but they'll be asking you as the agent, hey, in 2026, 27, 28, 29, whatever the case may be, what do you want to do with your assets in your donor advised fund? And you can say, oh, I'd like to give $20,000 this year, next year, the next 3 years to PC. And what you're doing then, right, is avoiding that 0.5% floor limit chunk that would be excluded from your charitable income tax deduction. You'll get the full $100,000 benefit in this year, and then you can parse out your distributions in subsequent years. So we believe we'll see this concept of what's been called bunching in the past with donor advised funds, with both corporations that might set up corporate donor advised funds, or individuals who have individual donor advised funds, to think about making perhaps that big gift in 2025, or as I said, they could do it in next year with the plan that they want to give out to PC in the next 4 or 5 years, a certain amount. And it's a way for them to avoid this floor concept by putting it all in the DAF. And the DAF, as I said, is very flexible. PC, I can't imagine would they'll of course give the gift to PC in any given year, being a public charity in very good standing. So donor advised funds, they are very flexible unless the law changes with the regulation of donor advised funds. Of course, that might change how people do their planning, but we think this will be an outcome of the One Big Beautiful Bill Act, that even more assets may go into donor advised funds in an effort to avoid some of these floor concepts.
And we work really closely with the Rhode Island Foundation, who handles donor advised funds. So they're very easy to work with. And you had mentioned Schwab and Fidelity. A lot of your broker or your advisor, your estate planner, they'll know which entities do have donor advised funds. So it's not that difficult to find a qualified group that handles those funds.
Right, absolutely. Another thing we just wanted to mention to you, and just to remind you of, because I do think it can get off the radar screen for some donors, and it's a really important asset just to continue to consider, is appreciated securities, right? So I mentioned this concept of the provision in the One Big Beautiful Bill Act of this permanent nature of the 60% limitation for adjusted gross income for cash distributions for appreciated securities for those that you've held for more than 1 year, which is typically the case for those who are making these types of gifts of typically publicly traded stock. There are ways you can donate privately held stock that are a little more rigorous and intense with some of the details, but that can be done as well. But what we were mentioning here, what we wanted to mention here, is certainly for those that have appreciated publicly traded stock and securities, subject to a different limitation compared to the cash 60% AGI limitation for appreciated securities to public charities like Providence College. You can deduct up to 30% of your adjusted gross income in any given year and carry that forward again up to 5 years if you were hitting those ceilings. In 2025, again, you wouldn't be dealing with the floor and that compression on the top income tax rate that we mentioned. If you were going to make a gift of appreciated securities, think about it for 2025. Of course, there's still a great asset to use in subsequent years as well. And why they're such a great asset to use is if, for example, you made the decision to make a substantial gift or commitment to Providence College, or any gift or commitment to Providence College, you wouldn't want to redeem the value of those securities and then donate the cash, right? Because especially if it's a long-term security, unless it was at a loss, which hopefully that's not the case for you, but if it were at a loss, you would do it that way. But if not, if it's appreciated securities, which the slide mentions, you would want to donate that directly to PC. And that avoids you having to pay capital gains tax if you were to redeem the security and then make the gift, which does happen sometimes, and I hate to see it. And it's just because people might not be working with an advisor or not aware of that benefit and way to make a gift to PC. So please think about it. If you are thinking about making a gift and you might have highly appreciated stock, a great asset to use. You don't have to pay the capital gains tax. It would be treated as any other type of gift, with the one difference being that 30% AGI limitation. But it's a very, PC makes it very easy for you to accept the security, and they would work with your broker to make that transfer. Okay, and then the last provision that we wanted to highlight, or for section of provisions here, are those relevant to your estate planning? And so the exemption right now, and since the passage of the Tax Cuts and Jobs Act in 2017 for estate tax on the federal level, has been quite high. It's increased every year. It's at the highest it's ever been. The exemption for estate tax is currently 13.99 million, just sniffing at 14 in this year. For an individual, for couples, you're doubling that, right, in terms of how you're thinking about jointly planning your estate. So quite high. The One Big Beautiful Bill Act kept the increased exemption concept and actually stuck it at $15 million per individual, 30 million then for married couples during the term of the act. So starting next year, you'll see this even more enhanced federal estate tax exemption. Also, that's married to this concept of gift tax exemption, which means how much you can give away, one can give away during their lifetime to their children, whatever the case may be. So the estate tax exemption is quite high, and that very high estate tax exemption only impacts for those who would be paying estate tax of a small percentage of the population in the United States. What I wanted to highlight, though, is this doesn't change the concept of the state estate tax, which is so important because you have the federal estate tax, but then depending what state you live in or where you claim residency, you may have a state estate tax. So just by way of example, here in Rhode Island, the estate tax in Rhode Island is about approximately $1.7 million, which is quite low, obviously, compared especially to the federal estate tax exemption. Massachusetts next door to here is 2 million. There's some states that don't have state estate tax, like Florida, New Hampshire, for example. So you should consult and see wherever you live and wherever you're domiciled, what the impact to state estate tax may be to you. But it can be quite significant, right? So for example, looking at those in Massachusetts that live there, the 2 million exemption per individual, that actually, it sounds like a lot, but adds up pretty quickly, especially if you own real estate, if you have life insurance. It's your whole bucket of assets that go into the calculation for your estate tax. So be aware that charitable planning can be quite effective for state estate tax exemption because you get a deduction for any gift made upon your death. You get a charitable estate tax deduction. And that can be quite powerful in minimizing your estate tax bill, or someone just would frankly rather that go to their favorite charity like PC and not to the coffers of the government in which they live. So be aware of that. The federal estate tax exemption for the foreseeable future quite high. State estate tax has an impact. This high estate tax exemption for those that have very substantial estates will be actually quite beneficial for some more sophisticated planning techniques that involve charitable trusts known as lead trusts. Of course, we mentioned you should consult with your estate planning attorney about this, but there are certain types of gifts that combine giving to your children and giving to charity in a way that can be very tax effective. And this high estate tax exemption can be a very good driver of that. If you have an estate where you will still have to pay the state tax over $30 million, for example, if you're a married couple, right? If you're adding up your assets and you fall into that category, this high estate tax exemption can help you make some really structured, sophisticated gifts that can benefit PC and your family and actually result in less of an estate tax bill. But we know this is important to people. We wanted to highlight it. It certainly is an important provision in the act, this concept of increasing the estate tax for the foreseeable future. So with that, I think we've come to the end of our slides. Andrea, I don't know if you had anything you wanted to add, but I'm not sure if we have any other additional questions as well.
We do have questions, and I just wanted to throw out, this is my favorite topic, estate planning. I know it sounds kind of strange when you talk about it because we're talking about assets that are transferred on death usually, but the whole concept of estate planning, taking the assets that you've earned during your lifetime and planning how you're going to distribute them, that goes hand in hand with this One Big Beautiful Bill Act, tax planning, charitable giving, all of the things that are important to you and how you can best give to your family, give to the charities that you love, and reduce the amount that's going back to or going to the government, in which you probably don't have, the strongest affinity. So talking to an estate planning attorney, talking to your advisor, all of those things are really painless once you get the first call done. And both of us encourage you to do that for lots of reasons. We do have some questions here, Liz. So does the universal tax deduction apply to all of those whose income is $200,000 or less? And do you have to give a certain amount? Does the universal tax deduction apply to those people whose income is $200,000 or less?
So, the in terms of do you have to give a certain amount? So the way you would calculate that is the standard deduction, for example, is around $15,750 for an individual next year. If your itemized income tax deductions are in excess of that, right, then you would be motivated then to not take the standard deduction, right? I think that's how you would think of it. So in terms of taking the standard deduction or not, that's what I would suggest would be your motivating factor. For the question, the income thresholds, the $200,000 or less is not something I'm familiar with. So
I'm not either. There's a follow-up here that says I can take the standard deduction plus an additional 2,000 joint if I make a charitable contribution. So I think that's the concept you were talking about. If you are taking the standard deduction, you could be eligible to take the additional 2,000. But
yes.
I didn't hear you say there was an income component to doing that.
No, the additional universal charitable deduction does not have an income component. That is correct.
Okay.
Yes. Yep. It's $1,000 for individual, $2,000 for joint.
There's a question about whether Providence has considered establishing our own DAF. Good question. I have not heard anything about that, and I'm not sure that's a conversation that's down the line. I do know that there are local entities like the Rhode Island Foundation that does a fantastic job with donor advised funds, but I will bring that back to our financial folks and see. I have not heard that conversation. For the extra senior standard deduction of $6,000 for married filing jointly, both do not have to be 65 or older. Susan has just told us. Thank you. I didn't know that. I thought it was the other way. And as a senior, class of 1969, will the One Big Beautiful Bill Act eliminate tax on Social Security benefits in 2025? Will it, and let's see. So let me ask that again. As a senior, class of 1969, will the One Big Beautiful Bill Act eliminate tax on Social Security benefits in 2025? And if so, will it start in 2025 income tax filings, or does it start next year in 2026? I've not heard.
I would say most provisions do take effect next year.
Yep.
But I would double check that. In terms of taxation of Social Security benefits, I'm not aware of any provision that eliminates any income taxation of Social Security benefits, but I'm not a Social Security expert, so I would double check that with your CPA if there are changes to Social Security taxation, or we can get back to you on that.
This bill is it 900? I think depending on where you read, this bill is 900 to 1,000 pages long and so comprehensive that just because the two of us, and Liz is more expert in it than I am, but for sure, don't know the answer to that. That doesn't mean that it's not in there somewhere. So please do talk to somebody to find out, because that's a good question. I don't know.
Yeah, I mean, your Social Security taxation is affected by a lot of different things. You know, that's what we mentioned with, for example, with the QCD benefit in terms, it is impacted by your adjusted gross income. Yep. So there might be just some secondary changes to your Social Security taxation based on some structure in the tax code, but I think it would be very specific to your own personal situation and how your other sources of income for you. Liz, thank you so much for your time. And this was great. If you would, everybody who's on the call today, if you would please take a moment to complete the survey. I believe it's in the chat at the bottom of this Zoom. And we're really grateful that you spent the hour with us today. Whatever you celebrate during this winter season, please, we hope that it's filled with joy and friendship. And we're grateful for your time. Thank you.